What is going on, everyone? I hope you're having a fabulous day out there. So, it is Wednesday, and today the Federal Reserve Board, they got together with Jerome Powell, and they have to decide if they're going to raise rates again, and they did. They raised the rates again. So what does that mean for you and me? What does that mean? Because I get questions about, the economy and how things affect us. Well, I think one thing we all really need to really take into account is that when the Federal Reserve raises rates, that means they are not giving out money as freely as they have before. So things start to contract a little. So instead of, let's put it like this. You're giving out money and you're like, ooh, this is hurting my bank account. And you're watching people get fat and happy out there, and you're like, maybe I shouldn't give them so much. It's starting to affect our economy. It's starting to affect the world economy. Our exports aren't as competitive anymore. Things like that. So they start to pull back money. Like, I'm not going to give you as much this time. That's kind of like how it goes. So the Fed influences banks and borrowing costs. Okay, you go get, I'll give you a great example. Banks. We've been seeing banks fail. I mean, we've had several banks fail over the last 4 or 5 months. It's because the Federal Reserve's raising those rates and money isn't cheap anymore. And that causes, the banks to, well, let's just be clear here. They can't lend out money as freely as before, and it places a strain on them. They got this thing called the federal funds rate. And what that is this. The federal funds rate is overnight between banks, they lend to each other. And they have a rate of what they lend to each other. They have their own special interest rate to what they lend to each other. It's called the federal funds rate. Now, when that goes up, they're not lending to each other as freely. Makes sense? Then banks get in trouble because they can't borrow money to get themselves out of trouble. Depositors, are covered by the FDIC, but only up to a point. So, something to consider there. Really, it truly is. The savings yields of our bank accounts move in lockstep with the Fed. Now, I get it. Banks ain't paying anyone any interest rates any longer. That's a joke in itself. I understand why they put that up there. They're giving, less than 15th of the point on your money now? It doesn't even make sense. Apple just came out with a new savings account with Goldman Sachs. That says, hey, you can have a savings account associated with your Apple iPhone, and it's actually kind of like a money market. Because when you go to a brokerage or a stock firm or a big investment bank, they'll give you a brokerage account, and they get these things called money markets, and they pay a lot more than your bank account. In rising inflationary environments, those money market brokerage accounts, interestingly, they pay more than some investments you would find in the market. It's really unique. Something to consider. None of this is investment advice. I can't go there yet. But I can tell you, becoming an investment advisor, I am learning a freaking ton. And I'm learning how unfair some things are to some people. And that's the truth. Some businesses, they don't grow their money. They let it set, and over time, their money decreases in spending power. Their purchasing power weakens over time, and when you have that money just sitting in a capital reserve bank account, you're going to lose your purchasing power. Put it in a money market or something, let it grow, let it flourish. That way there, when it comes time to take that money and put it to work, you've got a little bit more spending power, and you've, added some growth and maybe some interest. Something to consider there. Okay, let's get back to on topic here. The Fed decision guides the stock market. You notice usually when the Fed raises the rates, the stock market goes down. Why is that? Well, there's a lot of moving parts to that. I'm not going to get into that, but I can say this. They get pessimistic. Stock market gets pessimistic. Banks ain't lending as freely. I mean, stocks are going to be, stocks we own are going to be affected because they are real businesses that operate on credit. Even the credit markets for bonds and things is affected. Things to consider here. It really, truly is. Interest rates affect inflation. Okay. Say like you go get a car loan. Like your average used car loan these days, you're paying like $1,000 a month because the interest rates are going higher. It was like the old days where, you pay just very minimal. No, those balloon payments are getting a lot higher now for the used car market. It's very interesting. And that's why the secondary car market is on fire right now. Everything has a cause and effect in the economy. It truly does. It's something to consider here. The Fed impacts the job market entirely. Okay, so we're seeing big companies, Amazon, Google, Apple. We're seeing Meta laying off thousands of people. Because money ain't cheap anymore. That means they got to start reeling it in. Hey, our balance sheet, our income statements really, you got to really put the brakes on how much you're spending and start looking at things more wisely. And that is my message in this video to each and every one of you who have asked me about the interest rates and the inflationary environment we are in. What does this all mean? That means you need to put the brakes on your spending, rein it in, be smart with your money, and better days are ahead. But right now, you need to be mindful about what you spend, what you save, and where you save. Because money today is worth more than money tomorrow. That's just a fact. Hey, I hope you got something out of this video. I appreciate you watching. My name is Jameson Sharp. They call me Doc. I am a financial services guy, finance guy. I'm studying for my license as an investment advisor, loan originator, and EA for taxes. So I know a few things, and I'm learning a ton on wealth management. That's it. That's all I got. Until next time, we'll see you later. Take care. Have a good one.